Welcome to the Explainer. Today, we're diving deep into mastering your money layout. Because let's face it, the modern financial world can feel like a total maze. Did you know that the average adult loses nearly $1,000 every single year just from a lack of basic financial knowledge? And if you're Gen Z, the game is rigged even harder. Statistically, you're making less than your parents did at your age while carrying double the credit card debt. But it's not your fault. You weren't untaught. You were never taught at all. In this explainer, we are breaking down the exact money rules that separate the people drowning in student debt from the ones quietly building wealth before 30. No boring economic jargon, just the actual playbook to master your money layout this year. Here is our roadmap for today. First, the cost of financial illiteracy. Then, why Gen Z is struggling more than millennials. Third, the 3 money rules school never taught you. Fourth, how to master credit card debt. And finally, building your passive wealth engine. All right, let's jump straight into Section 1, the cost of financial illiteracy, or basically the real price of what school totally forgot to teach you. So the National Financial Educators Council ran this massive survey, and honestly, the data is just staggering. The average American adult estimated they lost exactly $948 in a single year, entirely due to a lack of personal finance knowledge. Just think about that for a second. That is literally nearly $1,000 just evaporating from your pocket. Money that, could have been invested, used to smash some debt, or just spent on a really nice vacation. Gone. Just because the system is wildly complex and poorly explained. When you take that individual loss and kind of zoom out across the entire adult population, we are looking at a $246 billion national knowledge gap. That's billion with a B. And this hits young adults the absolute hardest. A staggering 42% of Gen Z is currently living paycheck to paycheck. When you're operating with zero financial buffer, losing almost $1,000 to financial blind spots isn't just a minor inconvenience, right? It creates this vicious, totally exhausting cycle of financial stress. Which brings us to Section 2, why Gen Z is struggling. Spoiler alert, the game is mathematically rigged. Let's look at the debt-to-income ratio. It's basically a massive pulse check on your financial health. Now, while millennials carried a 12% debt-to-income ratio at this exact stage of life, Gen Z is facing a brutal 16% ratio. Why the jump? Well, because the fundamental costs of simply existing have skyrocketed. We're talking about a 31% rise in real housing costs and essentially double the cost for things like auto insurance. So even if your salary looks pretty good on paper, the sheer mathematical reality of your fixed costs is just eating up a massive slice of your pie. And this brilliantly illustrates the nuance of the generational debt crisis. On the surface, you might glance at the numbers and say, wait a minute, millennials have a higher average student loan balance of over $32,000 compared to Gen Z's $21,000. But here is the absolutely critical context. Millennials are older. They've been racking up that debt through graduate programs and years of compound interest. When you look at the exact same age bracket, like 20 to 25 years old, Gen Z actually owes 13% more on student loans than millennials did at that exact same age. The debt burden is literally accelerating. So what's the real world's consequence of all this mathematical pressure? Well, according to a global survey by Deloitte, 55% of Gen Z have actually delayed major life milestones because of their finances. Whether it's buying a home, going back to school, or starting a family, financial stress is forcing more than half of an entire generation into this maybe later approach to adulthood. Honestly, if you've been feeling this anxiety, just know it is a statistically normal reaction to a totally abnormal economic environment. You aren't crazy. Let's transition to the good part. Section 3, the 3 money rules. These are frameworks actually built for today's world. Okay. You've probably heard of the traditional 50-30-20 budget rule, right? 50% for needs, 30% for wants, and 20% for savings. But here's a massive reality check. Rents have surged 129% since 1999, while income's only crept up 77%. If you live in a high cost of living area, keeping your rent, groceries, and insurance under 50% of your take-home pay is, well, practically impossible. That's exactly why modern financial advisors recommend the 60-30-10 rule. It allocates a much more realistic 60% to those skyrocketing essential needs, 30% to wants, and 10% to savings and debt payoff. It's a budget that actually reflects the real world. So definitely adopt that 60-30-10 split, especially if you're in an urban center. And crucially, you guys, still allow for your weekly little treats. Data shows that 92% of Gen Z indulge in small treats, like that specialty iced coffee weekly anyway. So just budget for it instead of feeling guilty. But here's the absolute non-negotiable. Before you do anything else, you have to build a 3 to 6 month liquid emergency fund. Think of this cash reserve as your financial shock absorber. It is a mandatory buffer you must have in place before you start aggressively attacking debt. Moving on to Section 4, Master Credit Card Debt, let's talk about escaping the high-interest trap. When it comes to crushing debt, there are two primary schools of thought, and understanding the difference is a real game changer. First, you have the debt snowball method. This is all about psychology. You list your debts from smallest balance to largest, totally ignoring the interest rate. You aggressively pay off that smallest one first to get a really quick win, which builds incredible momentum. On the flip side, the debt avalanche method is purely mathematical. You list your debts by interest rate and attack the absolute highest rate first. This method will mathematically save you the most money in interest over time. So you're probably wondering which one is better. Honestly, the one you will actually stick to. You have to match your debt payoff strategy to your own personal psychology. If you get easily discouraged and you need to see those accounts hit zero quickly to stay motivated, go with the snowball. But if you are super disciplined and just hate the idea of paying the banks a single penny more in interest than necessary, use the avalanche. At the end of the day, consistency is the only way to win this game. Finally, Section 5, Building Passive Wealth. This is all about creating your automated wealth engine. Look, building passive wealth doesn't require you to sit in front of 6 glowing monitors day trading stocks like you're on Wall Street. It's actually incredibly boring, and honestly, that's the secret. The automated wealth engine just has 3 simple steps. Step 1, we actually already did it, building that emergency fund buffer. Step 2, choose low-cost diversified investments, things like target date funds or broad market ETFs. And step 3, put a percentage of your gross income, ideally working your way up to 15% on complete autopilot. Set it and forget it. You want to automate those contributions so the money moves directly from your paycheck straight into tax-advantaged accounts like a Roth IRA or a 401k. By automating this whole shebang through platforms like Fidelity or your employer's plan, you completely minimize the effort required. You are basically taking human emotion and willpower totally out of the equation. Instead, you're relying on a rock-solid system to build your wealth safely in the background, while you just go out and live your life. Now, what's really interesting about this next stat is how it completely shatters the stereotype of the, reckless, overspending young person. When a recent Bank of America study asked people what they would do with an extra $300 a month, 54% of Gen Z said they would put it straight into savings. That actually outpaces millennials, Gen X, and baby boomers by a massive margin. Gen Z is actually the most savings-oriented generation right now. You already have the instinct to save. You just needed the right framework to deploy it effectively. Which brings us to the ultimate question. You now know the hidden cost of the knowledge gap. You understand the macroeconomic headwinds working against you. You've got the modern 60-30-10 budget rule, and you know exactly how to conquer debt and automate your investments. The playbook is literally in your hands. So, what will you automate with your very next paycheck to start building your own wealth engine? The best time to take control of your money layout is right now.